Precious metals tend to do well when people are concerned about the efficacy of savings products denominated in fiat currencies and their maintenance of purchasing power. Anybody who isn't concerned about the maintenance of purchasing power in long government bonds, I think, needs their head examined. Quantitative easing, negative real interest rates, debt and deficit, and the impact on pensions from the degradation of principal in the long-term bond market, to me, guarantee, they don't suggest, they guarantee the diminution of purchasing power of savings products denominated in fiat currencies. I don't see any particular way around it.
RickRule, a seasoned expert with decades of experience in the commodities business and former president and CEO of Sprott U.S. Holdings, recently shared insights into the current state of the commodity market. He shed light on potential winners in this scenario. One of the critical points Rule emphasizes is the role of gold in responding to positive trends in the precious metals market. Gold has exhibited a general price uptrend since the 2000s, albeit with significant fluctuations. In contrast, silver typically follows gold's lead by rising in value after gold has already experienced an upswing. Analysts anticipate that both metals are on the cusp of setting new records. Jeff Christian, managing partner of commodities consulting company CPM Group, predicts record prices for gold and silver annually, with this milestone expected to occur sometime between 2024 and 2026. Rule also touches upon the unique characteristics of investing in silver stocks, representing investments in silver mining companies. While silver stocks can offer exciting opportunities, they are known for their volatility. In recent times, silver stocks, as represented by the Global X Silver Miners ETF, SIL, have faced challenges and underperformed compared to the broader market. Over the past year, SIL recorded a return of -17%, significantly lower than the benchmark Russell 1000's total return of -8%. Before diving into Rick Rule's insightful interview, subscribe to our channel and give this video a big thumbs up.
My experience, Anthony, and I can't tell you why, is that gold moves first in a precious metals bull market. I suspect because there's a fear buyer, a motivated fear buyer. And when the precious narrative gets established among the investing public, then silver, perhaps because of its lower unit price, begins to move further and faster. The beginnings of the move in the silver market are usually an indication of the fact that we're halfway through a precious metals bull market. I'm not sure why that is. Speculators should note that the most volatile asset class in that sector are the silver stocks, simply because the market capitalization of viable or threatening silver equities is so small that when the generalist investor warms to the narrative, there literally is not enough market cap to accommodate the flow of funds that comes into the sector. I remember coming into the mining investment field in the 1970s and watching, as an example, a little penny dreadful called Coeur d'Alene Mines go from 10 cents a share to $65 a share. I was too new to the sector to know to participate. But the next time silver ran, I personally was involved in both Silver Standard and Pan American, which ran from 72 cents and 50 cents respectively to over $40 respectively in 6 or 7 short years. Those were very pleasant experiences, obviously. Precious metals tend to do well when people are concerned about the efficacy of savings products denominated in fiat currencies and their maintenance of purchasing power. Anybody who isn't concerned about the maintenance of purchasing power in long government bonds, I think, needs their head examined. Quantitative easing, negative real interest rates, debt and deficits, and the impact on pensions from the degradation of principal in the long-term bond market, to me, guarantee, they don't suggest, they guarantee the diminution of purchasing power of savings products denominated in fiat currencies. I don't see any particular way around it. I'm not trying to say it has to happen tomorrow, but I'm trying to say that anybody who would, as an example, buy a U.S. 10-year Treasury paying, 4.7, 4.8% in a currency where I believe the real purchasing power deterioration is closer to 7% than the CPI stated 3.9%, needs their head examined. They're bad at math. I wish what I was saying wasn't so. Gold is usually insurance against chaos, and my life is pretty good. I'm not looking forward to chaos, but I prefer to own it. Markets always work, but markets are messy. People don't like the way they work, and the impacts are always a lag. It is very true that the cure for low prices is low prices. Low prices stimulate demand and they constrain supply. Similarly, the cure for high prices is high prices. They stimulate conservation, they stimulate supply. But it takes years in a capital-intensive cyclical industry for the market to work on either the supply side or the demand side.
Federal Reserve officials have recently decreased the likelihood of an imminent interest rate hike, but all eyes are on the upcoming September and October Consumer Price Index (CPI) reports. These reports will play a crucial role in determining whether the Fed decides to implement what could be a final increase in short-term rates on November 1st. In August 2023, the Consumer Price Index in the United States showed a faster increase than the previous month, rising by 3.7% year over year, surpassing the 3.2% rise seen previously. Notably, some experts, like RickRule, have criticized the CPI as a flawed measure due to its omission of taxes, which are a substantial financial burden for most households. Rule argues that overlooking taxes when calculating a cost of living index doesn't provide a complete picture of the economic reality many face. After their meeting on September 19th to 20th, 2023, the U.S. Central Bank decided to maintain interest rates at their current levels. As indicated by CME's FedWatch tool, market expectations show a 97% probability that the Fed will keep rates unchanged, up from 92% just a few days earlier. The likelihood of a 25 basis point rate increase at the November 2023 meeting, which had risen earlier in the week, has slightly decreased from 41.1% to 40.8%. Rule aptly points out that when interest rates rise, the value of existing investments tends to decrease.
I think we've been schooled in the last 40 years, which I think were the most benign economic period in human history, not to be afraid. Interest rates, both nominal and real, fell for 40 years. The benefits of globalization, the benefits of inclusion in the workplace, the benefits of demographics, all of those things conspired to make the last 40 years a wonderful time to be an investor and to be a consumer. I'm not saying that the world's going into a hell in a handbasket, but I think we're entering a period of time that's more challenging. When your expectation of the future is set by your experience in the past, our experience in the past has been pretty unchallenging. And I think as a species, or at least as investors, that we're less prepared for the future than we ought to be. Many times when I give talks like this, particularly to people of your generation who haven't really experienced the trying times that might have existed, say, in World War II or in the period of the 1970s, there is a sense that things only get better. And I suspect in the very long term, that's true. Things only get better. But there is also, I think, less fear, less experience. As an example, a younger audience might question my view of inflation. They may say, well, the CPI stated rate of inflation is barely at 3. What's the concern if I'm getting 5% in a treasury security? I would suggest that the CPI is a flawed measure of inflation. It's a consumer price index. It is, quote, hedonistically adjusted, which means that if the big thinkers that compile the index think that an item is more valuable than it used to be, that they adjust its relevance to the index. But much more importantly, Anthony, the CPI doesn't include tax. The largest expense suffered by most households in the developed world is tax. And the idea that they don't include tax in what purports to be a cost of living index is borderline fraud. It's insane. The way I informally calculate the depreciation of my purchasing power in US dollars is that the depreciation of purchasing power, including tax, means that my savings are losing purchasing power at about 7% compounded annually. The idea then that I'm happy about receiving a 5% yield in a currency that's declining in terms of purchasing power by 7% compounded means that my return on capital employed in savings is a minus 2% a year compounded, not particularly attractive. And you put your finger on really the death trap, which is to say the ability of portfolios for pensions and endowments, as an example, to meet their obligations 25 or 30 years hence. There's two problems there. The yield that they're getting from their long-term debt instruments is insufficient to maintain the purchasing power at the same time that the rising interest rates are lowering the capitalized value of the investments that they already have. So as an example, a university endowment that bought treasuries.
With the possibility of a rate increase in November looming, financial markets are closely monitoring these developments, and the upcoming CPI reports will play a pivotal role in shaping the Federal Reserve's decisions and their implications for the broader economy. How can investors best position themselves to adapt to changing market conditions and make informed decisions? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.